I'd like to just start a conversation about machine learning for algorithmic trading. What really is that for those who are not familiar with it, and how do you apply this to real life?
Yeah, obviously machine learning per se has been a pretty hot topic for 5 years at least, more like probably 10 years. Investment as an industry has been coming to the machine learning table maybe over the last 3 years or so. But of course, investment has a very long quantitative history. I mean, there's decades and decades of research trying to figure out which variables, which indicators are predictive of returns, because people have been trading since the first company was started, basically, or listed. The idea of using machine learning for trading really has gained popularity, especially once also alternative data became a thing. Alternative being the data that is normal in all the other businesses. So that's not alternative, but the standard data, pay a credit card transaction data, or things you read on social media, and satellite images, and everything that is used or generated by other businesses in the normal course of business. That is now increasingly used in machine learning in the investment industry, with the goal of getting some insights into how maybe a specific industry is going to do, or a specific company, or a specific brand or product. And in the past, they've also done this. They would send like shoppers to malls to figure out whether there's more foot traffic or less, for instance, to see how consumer spending would evolve. Now, of course, you have credit card transaction data. So now we have much more information, and there was an incentive to invest in not only the data itself and the infrastructure to manage it, but also in the skills to process the data in a sort of smarter way and get the ability to look into the future through machine learning. So that, of course, was very promising, because the general idea in finance is that efficient markets, you can't really extract any information from past prices, because if there were any information, somebody would have already made those gains, just like the dollar bill on the sidewalk that can't be there because somebody would have picked it up. So that's where machine learning comes in. New data becoming available as elsewhere, and many funds trying to figure out now how they can use this for an actual trading strategy. Because as we briefly talked about before we got started, what's specific or slightly different about using machine learning in trading is that you always have to not only think about your standard machine learning workflow, which is you get some data and you have some objective or outcome you want to predict, and you do your whole feature engineering and data cleaning and model setup and cross-validation, evaluation, and so forth piece. But once you get predictions, say for returns of those stocks that are in the maybe S&P 500, then you also need to think about, so what am I going to do with those now? So am I going to buy the best 10 stocks, or short the worst 10 stocks, or something else? And how am I going to manage risk? And right? So you have a whole sort of normal trading workflow that tags on to the machine learning piece right away. And your model is only as good as it allows the trading strategy to be after the fact, right? So you have this sort of two-step approach that is integrated. And that's what the book is about, basically, to demonstrate how you can integrate these steps. So build models that are hopefully predictive, and then see how they would fare in historical market conditions. And then you get a sort of monetary feedback on how good the model is actually. So that monetary means I made 10% per year, or 100%, or I lost everything. So you get a little bit of course, results across the board, but you get a very specific result, actually in dollar terms, rather than, well, the AUC or my mean squared error or the correlation is X.
Yeah, absolutely. I think you touched on this already, but a relevant question came in from Matthew asking, how efficient will machine learning algorithms work in the stock universe, right? The real world.
Yeah, it's super efficient. It was handed down to us from heaven, and it's a machine to print money. Of course not.
Obviously.
That would be great. We know life a little bit. These things that sound too good in life, they're really true.
Yeah.
So machine learning is, of course, a good tool. And as usual, to the extent that you have complex data, it will be more suitable or more effective at extracting information from that data than humans.
Yeah.
We know that. But markets are very competitive. So the challenge there is that even though you may have a model that really looks good over the last 3 to 5 years, it may be only a certain time that you're able to actually make money based on that in the market, or maybe not at all, because maybe others have already figured out that this could work and they're all trading on it and the gains are very small and your trading costs are going to eat the gains.
Yeah.
So it's hard. And sometimes you need a little bit of scale, but you need to take a look at funds like Renaissance Technologies. It's founded by Jim Simons. It's this legendary fund run by pure scientists. So there are no typical Wall Street traders in there. There's actually just a bunch of mathematicians and physicists and astrophysicists and whatnot. And they have been using algorithms and machine learning since the 80s. And they have achieved returns above 50% per year since then. Like no other fund is coming even close to that. They're managing around $20, $25 billion or a bit more these days, but it's mostly internal money because they also can't grow too big. So it's not like a Bridgewater with 200 billion plus, but the returns are amazing. And they started very early and they have been using these tools since the 80s. So it can work, but it ain't easy.
Yeah, absolutely. So it's not a money printing machine for those who are wondering. Now, going to the comments, we have a lot of guesses as to the number of pages. So Stefan, you're going to have to tell them the answer at some point. So we've got 780, 1067, 587, 1200, 733. We have a lot of 1500. Wow. Tushar said 820.
On the last page at the bottom, it says, can you read that? Where is it here? 790.
Oh, wow. The 780 came really close. Pritam said 1800. So you're going to have to keep writing.
But actually there is like some Roman numerals before that. So there's 22. That's all the intro stuff, table of contents. So it's like 800 and a bit.
Yeah, Michael says it's a nice surprise seeing us here together. He guessed 407, but he's curious to see the average.
Michael Papas, how is it going?
Michael, please take the average and report back upon in the next few minutes. Okay, so let's move on to more questions. We got one here. Why is the book so thick? Is algorithmic trading difficult?
I just hit all these little jokes in there in the footnotes to check if anybody actually reads this. So the book has, 24 chapters or so. It's a second edition. So actually it has more pages. We had to squeeze the margins a little bit. It has like more like 850 pages in like the original format.
Yeah.
The reason is that the book tries to, first of all, give you 5 chapters of sort of background. How do you use financial data, alternative data, and a little bit of the background of the research that financial economists have come up with over the last 30, 40 years at least to evaluate all sorts of different hypotheses, how you could predict returns, which is useful for you as a starting point, right? Because you don't want to reinvent the wheel. And then there's a whole piece of how do you actually manage a portfolio. So one thing is to predict the returns for one stock. Another thing is now that you suddenly own 20 or 30 or 40 of them, how much do you invest in each of them and how could you optimize that potentially? So there's a whole kind of piece of content on that. And then we have, 7, 8 chapters on I call it the fundamentals of machine learning, which is from linear regression to gradient boosting. So the typical algorithm for like tabular data with an excursion to backtesting. So we use Zipline and Backtrader, which are 2 popular Python libraries for backtesting in the book. So we explain a little bit how they work, what the architecture is, and show you how to work with them to load your own data and several important steps in the workflow. And then we have 1 3-chapter part on natural language processing. As I mentioned, alternative data is a real big thing. So for instance, processing financial statements of companies and trying to figure out if you could predict earnings surprises based on what companies report. There's an example there using word to vector technology algorithms. And then there's deep learning. So then there's another 5 or 6 chapters on recurrent neural nets and convolutional neural nets, and then the real hip stuff like generative adversarial networks, which is like very new. The goal is to generate synthetic training data. So one thing in finance is that actually the data in finance, the pure market data, is actually quite limited. And that's because you have only that many equities, for instance, that are trading worldwide. Say it's 100,000, which is like a large number. That's really what you have. And so they trade, and sure, they trade on a tick basis, and some trade very often and others less. But you take the NASDAQ, for instance, tick data. So we use an example where you download the NASDAQ actual real tick data, which reflects the order book and what's really happening in an exchange. That data set for one day is 10 gigabyte in size. That is, of course, it's a substantial data set, but look at what Google is hosting on YouTube, right? Look at the amount of data video is generating online and so forth, right? So if you look at web scale, financial data is actually somewhat limited. So that means that if you always try to train models on those data, at some point you're going to hit a limit, right? So you run into risks of overfitting on that limited universe of data, and maybe also future scenarios, because the world keeps on changing, they may also not be really contained in those data. So wouldn't it be awesome if we could generate artificial data that is basically representative of financial markets, but slightly different, right? So same but different. And so people have been working on this, and there are some interesting architectures that produce reasonable results. That's like very early stage from the research frontier. So this is not like a off-the-shelf solution you can just take and implement, but it's something that's in the works. And maybe in 3 to 5 years, actually, you can do this properly at scale. And all the large funds, or at least some of them, are certainly working on this. So that's kind of something. So I'm in the book, we replicate a paper that was published at NeurIPS, I think at the end of 2019. So that's really brand new stuff. So we show how to do that. So rather than doing the celebrity image GANs stuff, we use financial data to generate time series of stock prices.
This is new for me. When I think of GANs, I was thinking of the images that float around saying this is not a real person, but I guess that's a really good use of GANs to create synthetic training data for.
Yeah, that's right. The first application was in the medical domain, actually.
Okay.
Because in medicine also, you have, of course, issues accessing patient data, privacy and whatnot. But of course, you could think if I had, so there's an example, it's a lab from ETH Zurich from Switzerland. They use various measurements that is taken in the ICU, in the intensive care unit, to see what the status of a patient is, right? They have all these different things attached to you and then keep track. And then they can predict whether you're going to, whatever, deteriorate dramatically. So they were able to generate synthetic data based on some 10,000 or so patient samples. And they were actually able to train a model on the synthetic data and predict reasonably well, as good as doing this on real data, what would happen to a patient in the real. Great, because getting all this data from patient is really cumbersome and costly. So if you find a different way of getting there and getting similar results, that's great. So they were the first to come up with a recurrent sort of neural network architecture that would apply the GAN logic to time series, and that's then been ported to financial data.
Very interesting. Thank you for sharing that. We have a question here from Raul that I know you just can't wait to discuss. It's all about Gamestop. So would machine learning algorithm method have prevented the GameStop loss that major companies experienced last week?
So that's a really good question. I think maybe. I think there are some cases when the world changes dramatically. Would it have detected COVID, right? Coming out of the woods, or would it detect these sunspot events that are pretty novel? Maybe near term, right? Certainly you see systematic funds, so quant funds that use some sort of machine learning join the trend pretty quickly. If you have predicted before the onset, maybe. Clearly there was some chat on Twitter. Apparently GameStop has been discussed since 2019 on and off, but other companies as well. So I think that's a definitely maybe that could have been detected. There are other technologies that are more like screening information in real time and keeping a good eye, like things that data miner does and so forth, that are not so much trying to predict something in specific, but more like monitoring a relevant universe of information and then trying to react quickly as things change. So it's hard when we have new patterns that are really different from what happened in the past for an algorithm to pick that up.
Yeah, absolutely. And we have several questions asking what book we're talking about. So I don't know if I could just put this. No, it won't stay here. This is the book, guys. Machine Learning for Algorithmic Trading. Stefan's the author. And since we're talking about the book, why don't you tell people, Stefan, who is this book for? Is this for traders? Is this for business managers, data scientists? Who's it
Yeah,
for?
so I think, first of all, there are some prerequisites that help establish maybe some baseline. So the idea is that you are already familiar with using Python and you have already some fluency in the typical data science libraries like pandas, the scikit-learn interface and workflow. And it helps if you have some background in financial markets. Then beyond that, you have to be really interested in spending some time in experimenting with different approaches. You have to be willing to invest in thinking about what data you could use, because very often you need to go above and beyond the standard historical price series, because as I said, there's very little information in them. So it's very difficult to systematically make money from that. So you have to think about other sources. All of that is since that will take some time, you should be somebody who has a serious interest in using this either for your own personal money generating hobby, let's say, or professionally. And the professional set of people that are portfolio managers, analysts, and the like, that are moving into using machine learning is fairly large, right? Most, say, masters of finance and whatnot that are quantitatively oriented, they're all integrating machine learning in their curriculum. So I'm getting a lot of requests from students, advanced undergrad, graduate students that are all interested in learning this, because what that book tries to do is to really sort of give you some of the theory, but more of all, give you a lot of different ways how you could implement this in practice. And all of these are then building blocks that you can combine and use and apply either in your work or at home.
All right, awesome. Thanks for that. So you mentioned that the use of Python, and I know the book includes a lot of code that you can actually replicate on your own for practice, right? So what are some of the Python libraries that one would use when working with this machine learning?
Yes, so maybe it's useful to point out that a big part of the book is actually making available really a lot of examples. So there's a GitHub repository that comes with the book that's very easy to find online. Just look for my name and machine learning for trading. There's more than 150 notebooks that show you how to get the data, work with it, and translate the model results into a trading strategy that you can evaluate. So the libraries we use are, on the machine learning side, there are no major surprises. We use the standard pandas, NumPy, universe, and then we have scikit-learn and LightGBM or CatBoost, or then of course for deep learning TensorFlow or PyTorch. And for natural language, we have also some of the standard things from Spacey to Gensin, Textasy, and whatnot, or NLTK. So they're on the machine learning side, there are no like big sort of novelties really, because we're building on the shoulders of the open source giants. And then on the financial side, you have Zipline relatively prominently, because it's relatively fast to run a backtest there if you use the pipeline API. Backtrader is an alternative. And all this has been originally developed by Quantopian, which used to be a crowdsourced hedge fund, which unfortunately closed its door at the end of last year. And some of the leadership moved over to Robinhood. So that means the platform that used this open source to actually allow you to develop algorithms and participate in competition is no longer available, but the software that allows you to do the same thing at home still exists. So that's what the book uses. And they have a few other pieces around that backtesting engine, things like Alpha Lens, which allows you to evaluate the signal quality of individual factors, or Pifolio, which allows you to evaluate the performance of a portfolio over time from various risk perspectives. So it's a very rich set of metrics and visualizations that you can get. There are also libraries like TALib that compute all sorts of standards, technical indicators from market data. So we use that quite a bit, because most of the examples for the basic strategies, they rely on market data because it's the data source that's most easily accessible. We have some fundamentals and several alternative sources, but mostly we rely on market data just because that's freely available still to some extent. You can use Quantopian, worked with Quandl. So Quandl makes available a data set that at least runs until mid-2018 that's of reasonably good quality. A newer source is Alpaca, which is a new provider that also makes available free data daily. And I think they're thinking about higher frequency as well. So these are accessible without major investments. I also work with a partner called AlgoSeek. They make available professional grade data. So their clients are hedge funds and the like. And we use minute data in one example. And so if you're interested in investing in actual quality data where you know really what you're getting is what happened in the market at the time, it was probably approximately, then this would be another good source. But of course, you have to then pay some money, and that's nothing we can use in a book that's meant to address a broad audience.
Okay, yeah, very cool. Thank you. So by the way, that GitHub link that you mentioned, that's also in the session description if people wanted to find that quickly. All right, ready for more questions, Stefan?
Of course.
Okay, awesome. So Daniel's asking, what courses do you recommend for learning machine learning applied in finance? Aside from the book, I guess, because obviously get the book.
Yeah, there isn't really. So I noticed, for instance, when we brought out the first edition, which was a little hastily and wasn't quite ready, that even attracted quite a bit of attention because there wasn't that much alternative. It wasn't necessarily because it was such an amazing book, but it was like a lot of people are interested. And there, on the book side, there is one recent book, I think it's also just called Machine Learning in Finance by Igor Halperin, Matthew Dixon, and one other co-author. That's a little more academic in nature and picks up several important pieces from the research front. So there's a lot on reinforcement learning and reverse reinforcement learning and some other aspects. So that's really interesting. But it's more like research frontier, similar to what Marcos Lopez de Prado, which is probably the most prominent algorithmic or machine learning for trading representative. He used to run quant trading at Guggenheim, like a large $10 billion plus fund. Also has 2 PhDs, was at AQR for a while, and is now in Abu Dhabi at the Sovereign Wealth Fund and runs quantitative trade. So he's like a real huge guy. But what he publishes is like super interesting stuff, but it's literally, this has been developed yesterday by one of the leaders in the field. So it doesn't teach you the basics to get there. So what is there in terms of courses? There's something on Coursera, I think also developed by Igor Halperin, who I just mentioned as the author of the book, while he was at NYU, that has some examples. And so Coursera has one or two other things that also address risk management, I think, and factor models and stuff like that. But compared to the generic machine learning offerings from Andrew Ng to deeplearning.ai and so forth, there's clearly much fewer that's available.
Yeah, absolutely. I was at a conference probably maybe 2 years ago, pre-COVID. Obviously, this was an in-person conference. And the presentation was on machine learning and finance. And one of the main things that we discovered there, that even universities at this point have issues finding content to teach their students on this topic because there's just such a limit on the resources. So I think that's maybe partly why the book is blowing up, but at the same time, it's a really great book and it's very well written. It's massive, but at the same time, it doesn't feel like it because the chapters are so well, I guess they're distinct enough that you can take it a piece at a time.
Yeah. Yeah. So that in terms of, if you're interested in reading the book, you don't, and also probably shouldn't read it like cover to cover if you want to, but it's good to pick and choose you want to maybe take a brief look at the introductory piece on how you get the data if you're interested in something in particular. But you can pick the pieces that you really care about. If you want to learn how the backtesting stuff works, then take a look at that picture, at that chapter, and then you can say, I want to know how I could use gradient boosting, or I can use word2vec. Then you can just go to those, and it will reference other chapters if they matter. So you can always. So it's not like you have to get through the 800 pages to get anything done. You can actually get started relatively quickly.
Absolutely.
Maybe on the why there's so few, or not so relatively little available on machine learning. And I'm an economist originally by training. I also have a background in computer science, but on the economist side, and that also applies to finance, there's a long tradition in using linear regression for everything, because you can measure the significance and you can publish and whatnot. So there's a very established way of doing things, and a lot of PhDs have been trained in this way. So maybe different from some other novel industries, right? Like the advertisement industry, where you have Facebook and Google emerging that are ready to embrace new things. In finance, it takes longer because the skepticism, oh, is this really better than what we've been doing? And we all know this so well. It naturally takes longer, and also for a good reason. They have a lot of experience, right? It's not just ignorance and resistance to novelty, but there is literally decades and decades. Nobel Prizes have been awarded for this. It's very sophisticated stuff. So the bar is a little higher to demonstrate that machine learning is better or useful, because you really have to beat an existing status quo, right?
Yeah.
It's not like a tabula rasa greenfield kind of situation as in other industries.
Do you think there's also a hesitation for people to share kind of their secrets to winning the market?
Yes, probably. If you look at the research departments at Google and Facebook that built their reputation on open sourcing and publishing things, so nobody knows what Renaissance technology does ever. Like there's zero information about this. People sign watertight NDAs. So there's literally over 30, 40 years, nothing has leaked what their secret source is. Wow. And the other hedge funds are very similar. So you see the difference, right?
Yeah,
so clearly some of these things are being used, but you have to join them to learn about it. And then you also can't talk about it. So
yeah, exactly. Then you can't share it, but at least then you'll know it. I know we have probably 10 minutes left. We'll shift to just taking questions from the audience. Quick reminder to everyone who's listening live right now, we will select 3 winners after the show to receive the free copy of the book. Ravik Jain from PACT is going to announce those winners. For now, we're going to shift back to questions, and the winners are basically chosen based on questions asked. So go ahead and ask questions on machine learning for algorithmic trading. We're going to move on to Greg's question here. Can you describe the controls around algorithmic trading that helps avoid dangerous massive sell-offs and the potential for an AI-generated crash?
I'm assuming you're talking about more the overall market rather than my sort of personal risk management. So you had a few like flash crash and ones piling up in a certain direction. I think this is something that's evolving. You have some correcting forces in there too, right? Because individual funds or those that run quant funds and have experienced these things, they have also no interest in experiencing losses in this way. There's, to some extent at least, there will probably, hopefully at least, some self-correction. But I think we're literally entering new territory that nobody really exactly knows what could potentially go wrong over the next 5 or 10 years as more and more sophisticated quant traders participate. Already a large majority of the trading volume is electronically issued or driven. I don't know. I don't have an answer to that. The risks are clearly there. The regulators are looking at that, but I don't think they are at this point up to speed. If you cite lack of resources for the general folks to catch up, it's not like the regulators are clearly ahead of the curve, for instance. I think we've seen an extremely rapid development on the data and technology front over the last 5, maybe 10 years, where many other things still need to catch up with this. So we'll probably experience some maybe unpleasant, hopefully not, but potentially unpleasant surprises over the next 2, 3, 5 years or so.
All right. The optimist in me says, no, we won't. It's all going to be okay, guys. But you're probably right. All right, moving on to
I'm an optimist in the long run for sure. So
yeah,
I think they clearly outweigh the occasional. Now we're down 10% suddenly, and nobody really knows why, and then we're back up.
Okay. Next question here is, Stefan, please provide some insights on financial feature engineering, keeping in mind trading strategies.
Yeah, so feature engineering is, as so often, really the most important aspect of the whole thing. And it's not just how you engineer them, it's also what goes into this. So what's really special about finance is that it helps to first figure out what is actually the universe I'm interested in. And it probably already helps if you say, I'm not going to go after the 100 most liquid and most heavily traded stocks where everybody is investing huge amounts to gain an edge, right?
Yeah.
If you look, say, some developing market or smaller caps and so forth, maybe some sector, and maybe you can take an approach where you try to gain. So there are these quantamentals. They try to combine fundamental investing with quant methods. They often really think very hard about what kind of data sets could they get about an industry from the suppliers of that industry or what have you, that could give them some insights into how the industry is doing down the road, or a specific company. At a high level, you could try to get data from all the suppliers of Apple, just to name a well-known company. But of course, we don't want something that's big. That would maybe give you some insights on how it's going to do 3 or 6 months down the road. That's one thing. On the other hand, if you work with market data using at least a diverse range of indicators that capture like important phenomena, if you're into finance, things like momentum, that there's a certain trend in the making, volatility is important. All of this kind of goes back to what financial economists have found to be relatively to be associated with future returns, but that's no guarantee. So to be really have an edge, you probably want to think hard what other data sources you could use. Social media is something that always comes to mind. It's another source that's too easy to access almost to be successful. But so you probably have to think a little bit harder. That's why the large funds, they have big budgets to invest in specific data sets, because that really drives the thing. So of course you can, in terms of to more specifically talk about feature engineering, the book mentions all sorts of different smoothing techniques and so forth. So they're all things of all kind of techniques that you can apply to maybe increase the signal to noise ratio a little bit in your features. But very often the big difference will come from really discovering useful additional data that you can use, rather than tweaking your algorithm a little bit and changing the number of the depth of your gradient boosting tree or add a layer to the neural network. Very often the big leap will come from, I really have a good idea of a new data set, or how I can get some text data source and extract some interesting work information from there.
All right, moving on to the next question. How long do you estimate it would take to build a working model if I was starting this from scratch? What skills would be helpful?
Starting from scratch assumes that you do have some of the prerequisites, like you have used Python, how to use pandas or scikit-learn. If you apply yourself to it in 2 to 4 weeks, you can certainly have something running, probably sooner if you just use the examples that are there.
Yeah.
So, I mean, that you can literally do in an afternoon, right? Because we use Docker to install it, so you shouldn't have any installation issues. And some of the examples you can basically just run. You download the data, of course, it takes a few minutes, whatnot. But so that's not extremely time consuming. What takes more time is to really digest and understand the different building blocks, right? From the data to the feature engineering, to the algorithm, and then to all the things you can do on the trading side. So we don't go in the book a lot into how do you manage risks. So the issue like stop loss orders, and so we don't do very complex trading strategy that dynamically manage your holdings. We basically take predictions and then very often do a long short strategy. That's a whole different aspect on which there are other books, right? So there you have more material. There's 5 to 10 books or so that have discussed that stuff at length. That takes a little bit longer. 3 months, I think, will get you into a position where you feel much more comfortable using these different tools, and you will be swimming by yourself and start really developing your own ideas and implementing them.
Yeah. Okay. Thank you for that. So 2 to 4 weeks or maybe 3 months, depending on your level of comfort. Okay. We have so many questions, but I'm actually going to take the very last question, because we are going up on time. Okay, let's go to Robin. What are the implications of using machine learning to handle missing data like KNN and dealing with outliers for extremities?
Yeah, so it depends on which sort of input data you refer. So financial data, especially returns, something that has been looked at for a very long time. And you probably heard of this phenomenon of fat tails and their outliers in the data. It's a tricky topic because depending on the data source, it may have errors. So you have to really carefully look at if I have, and I'm just talking about data, market data, right? So price data and the returns that you calculate from those. Then you really have to investigate a little bit if large real, because sometimes large returns happen. And
right.
There may also be just a data error. So stocks, for instance, stocks, they split. So suddenly you have twice the number of stocks or half the number of stocks or so, which means that the prices adjust accordingly. And if the data set didn't really reflect that properly, or you didn't make the adjustments, and suddenly you have 100% return there, which is just because you didn't factor in that they just the stocks in two. So that would be a minus 50 return. But so you can have errors in the data or actual outliers or actual inliers that look like outliers. So you have to be a little bit careful there, maybe more so than in some other domains.
Okay, thank you. Yeah, so I know I said that was the last question, but we do have a couple of questions asking if the session is recorded and is there a link. Yes, this session will actually stay recorded on LinkedIn, on YouTube, Pact YouTube channel. I will later upload this to the Story by Data YouTube channel. So you'll find it in a whole bunch of different places and on Twitter. I'm not sure if it's actually live streaming on Twitter. I haven't checked. It's my first time. So might be on Story by Data Twitter as well. But Stefan, as we wrap up, my last question to you is, what do you think is going to happen in the next 5 to 10 years? Just realistically,
in the
not
world,
pessimistic or optimistic, but where do you see the technology going in the trading space?
I think that just as in many other domains, for those people that provide information research to a portfolio manager that as a human still takes decision, it would be much more common to incorporate predictions, machine learning results, and so forth. Because simply, just like at some point Excel became normal, then Tableau became more standard, just similarly, machine learning will become more standard, either because people learn to code or because there will be better tools. So that's one piece, right? So the analyst workflow is going to change. There will be more trading strategies that will become automated. So I work with clients that have strategies that are being run essentially manually today, but they use very specific quantitative signals already. So clearly, these are things that you can automate. They're very often based on some proprietary data feeds or what have you, but you can clearly translate that into a machine-driven strategy by simply learning how to react to these signals automatically. And then often it becomes more stable, more robust, and more scalable at the same time. So these things will also become more prevalent, which also means this is not that super exciting to do, right? Because essentially you monitor a certain number of indicators, and you have over a year learned if these two go up and these go down, and the other one is in the middle, then maybe I should buy. Or it's not necessarily the most exciting thing to do over time. So you can have machines do that, and then you can think about other things doing yourself. So I think it will go a similar path as in other industries, where you gradually automate, you get better information into the decision-making process, and you automate some tasks away and free up resources for others.
Absolutely. Thank you for that prediction. I personally learned a lot, and I think the audience got a lot of value out of the session as well. So thank you for your time.
Thanks for having me, and I hope it was useful for everybody else who invested some time.